Can you see me okay? Great. Glad you're here. Welcome, trading buddies, to Charts and Chats with Gordon Scott CMT. That's me, and I'm glad you're here. And I've got a chart I want you to look at. This is, since the weekend has ended, the difference between what's happening with the Aussie yen and what's happening with the NASDAQ 100 index. Something's got to give. You got a chart going up and you got a chart going down. So what does that say? Well, it says that the U.S. Technology stocks market is a lot weaker than most of the other indexes. And although globally investors are actually kind of interested in putting money somewhere, they're not so much interested in putting it in tech stocks. That's what that says. So what does that mean? It means probably the big technology companies are going to have another rough week ahead. Well, that kind of fits with my countdown to doomsday of May 14th. So if big technology stocks are so influential that they're going to lead the markets lower, you probably aren't going to be wanting and want to investing in U.S. stocks very much, right? Where can you put your money right now? That's one of the things I'm going to show you a few charts on. But before we get into that, let me make sure we got everybody um, uh, going here. Is this? I've got kind of a funny thing. Hopefully, you can see my charts and hear my voice. And I got a chat coming in. Hey, what would happen to Aussie yen then? Yeah, all good, everybody. Terrific. Thank you. I'm going to actually share my charts on directly on the screen now, and yeah, and then let's see if we can. There we go. Uh, yeah, infinitely me. Yeah. Hang on a second. When I get to my screen sharing, a little different setup going on with my. There we are. Okay. All right, how's this? Can you see the charts? What we're looking at here is the S&P 500 and the Russell futures. These are the overnight futures, so that we're real time 5 minute chart. Um, and what we see is the similar pattern. We're moving up at first on Sunday and then down since then, right? Notice also we got the Russell kind of moving up here just in the past couple of hours, or 1 hour actually, since 5 minute charts. Not much of a move up, but the strongest counter move since it started moving down. And so let's go back and answer the question though. What about the Aussie yen? If the Aussie yen's going to continue to go up, is that going to be a good place? Yeah, really, what's happening here is inflation in or inflationary expectations in the U.S. dollar. Okay, so just as a reminder, what happened last Friday was that the non-farm payroll report in the US came out and was way below expectations, way below. So let me see if I can bring up Forex Factory here, and you can see it for yourself. The expectation was for let's go back to Friday. The expectation was that the U.S. jobs report was going to bring out the news that there would be 1 million more jobs that had been created in the past month. And if I zoom in here, you will see a little bit better. Yeah, there we go. So 1 million was the forecast, or close to. And what came out was 266, like 75% below expectations. Yikes, right? So, how are they that far off? Well, if I go back a little bit and I look, last year's data, this is June 2019. There was a moment in time that was similarly under performed. 169 were expected, and only 79 came out. I mean, the scales are completely different because it's pandemic world. But pre-pandemic, there was this moment where the miss was huge. What happened the next month? A tremendous overshoot of jobs. So here comes the forecast, and that's the actual way over. So see, what's happening in my mind is it's potentially a delay. If I went back and looked for any time that this happened where the forecast was super high and the actual was way low, almost always there's this big jump the next month. So it's like the job data gets delayed. Somebody's monkeying with the numbers. I don't know. Most of the time, this number here doesn't get a lot of manipulation or evidence of manipulation for it because it's kind of too important. Everybody wants to know. Everybody needs to be able to rely on that. I have a hard time believing that it's 100% accurate all the time when it's a government institution, and I just don't trust governments anywhere. So, I'm one of those tinfoil hat guys who just know governments are bad. If they can lie to you, they will. I'm of that mindset, and yet I also know that there's, it's like a rigged sports game. If assuming there were a rigged sports game, if what you were doing was rigging it to try to make it so that you would win money from people putting bets, you can't rig it all the time, because if you do, then people are wise to the game, and they stop betting, they stop participating, and you can't fleece them anymore, right? So you can't rig it all the time in government either, and particularly in this report, it tends to just be not pristine data, not good. No, 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 no. Just less likely to be straight up cheating all the time in an egregious way. Now, this last time around, it could have been somehow just artificially suppressed for some reason. Why would anybody want to artificially suppress? Well, think about what happened in terms of the um, news that came right after this. So the data comes out that, oh, jobs are a big miss. Oh, that's terrible for the economy. And then immediately the US dollar drops significantly, like to new lows. And gold goes higher. Yeah. What's that all about? That's all about inflation, or the fear of inflation. Because what that means is that if the economy is bad, if the US economy is bad, then the US government and the US Federal Reserve, the US central bank, are going to want to try to do something about it. Well, what if somebody in politics and in the banking reserve system, and who knows, I don't know wherever, what if what they wanted to do was have an excuse to print more money? And they said, well, if we bring out a report that's really low and we come along and say, we're going to print even more money, then nobody will mind that we do, right? And so that's possible. I don't know. I don't know if that's a real thing. It's not important to me, actually, because I don't have any control over that. What do I have control over? I have control over what I trade and where I put my money and how much of it I put in what place, right? So I look at this situation, I say, that's what happened, whether real or imagined, corrupt or not. That's the number. What do I do about it? Or what is the market doing about it? Well, what the market was doing about it was running down the dollar and running up things that the dollar is priced in, like stocks. And so, how does that fit with my doomsday scenario, 56-week pattern, and so forth? Well, it's probably going to dampen the selling in stocks if people are more afraid about inflation, about the dollar just collapsing. That being said, there still could be some selling, but once the selling has kind of worked its way through, there could be a tremendous upward move in U.S. stocks. There could be a nice bull market coming along, starting somewhere in early summer, midsummer. Now it might be, there might be more and more pressure as people sort of sell off all of their COVID trading, but eventually after that, it could move up very strongly if in fact that's what people want to do, is outrun inflation. So anyway, we'll talk about some ideas of where we can go and how to do that. Um, so let's see. I'm having trouble getting the chat back up. I see I got some chat comments I want to respond to, but I'm not, for some reason, able to see where the chat window is popping up here. So I apologize if I can't see the chat. Oh, there it is. Got him. All right. Helen, people are annoyed with big tech, too socially irresponsible. Seems like Aussie yen topped out at 85.74.6 just now. You think there are more legs, all-time high? Um, I don't, at least not in the short term. If in fact the U.S. markets are going to go down um, for today, as I expect that they might, then I wouldn't expect the Aussie yen to go up. On the other hand, if U.S. markets make a turn, I mean, look at the Russell right here; it's heading up, and maybe the S&P. S&P is kind of heading up a little bit. If that turns the Nasdaq around and brings that up, then yeah, Aussie yen will go higher because again, Aussie yen and Nasdaq are 75% correlated. We got this huge divergence just over the past 24 hours between the two, but that won't hold. So the big question is who's going to follow whom. My expectation would be that the Aussie yen is going to follow the Nasdaq and they're both going to go lower. But if they don't, well, then they're probably both going to go higher. So uh, I know that's very unsatisfying. It could go up, it could go down. What do I think is actually going to happen? I think they're both going to go down. However, there will be this moment where they find some turn, and yeah, then the Aussie yen will go make new highs. Let's see. Unemployment numbers I know are off. They don't even count folks who are 6 months unemployed. Um, let's see. Yeah, that's true. I mean, the whole employment thing is really weird because people are getting so much benefit from, I mean, unemployment benefits, payouts, and stimulus. Yeah, I mean, I know people close enough to me that young kids who they COVID situation, they went and found as low price a living situation as they could. And stimulus comes along, it's like, oh, 3 more months. I don't have to bother going back to work. I'll just sit around playing, video games or Dungeons and Dragons or what. But so let's see. Hopefully, I didn't mess up my camera too bad with that move. Anyway, the unemployment thing is a real issue. That is going to affect the U.S. economy, no doubt. All right, before I get going, oh, another question from Helen. If the dollar goes any lower, don't you think all other currencies start pricing themselves out? It all happens instantaneously. If the dollar um, goes lower, then the currencies, go in relation. So in other words, the euro's moving up, right, because the dollar's going down in the dollar euro pair. But if you take currency pairs that are not dollar related, then that makes kind of an interesting situation. So, like for example, what about um, yeah, I'll just try and pull it up here. We'll go euro Aussie. Mm, that doesn't look very. Oh, it's not the that's crypto. Like my forex indexes. There we go. That's better. Yeah. So I mean, that's an interesting move that you've got the euro dropping compared to the Australian dollar. But I think that is all about what I'm going to talk about after the interview I show you, and that's all about the gold trade. So, all right, we'll come back to this. I thought I was going to be able to say something real quick, but I'm not. Now, let me tee you up for something that we've got that we're about to do here, and that is uh, I have an interview with Jay Woods, my first guest when I started this program a little over a couple months ago. Jay Woods, 28-year market maker for the New York Stock Exchange, now a floor trader with an outfit called Drive Wealth. I got a chance to catch up with him again and just go back, check in with him, see how he's doing, see what he sees on the floor in terms of volume trading coming in. I was asking him a few questions like that. It was an interesting conversation, and hopefully what we're going to try and do is play the recording of my conversation with Jay, and we'll see how that comes across. So be sure and chat in as you are watching it, assuming you can see it, and the sound is coming through, and that everything's looking good. So if you wouldn't mind, go ahead and play that recording. Jay, really glad to have you here. Thanks for taking the time. You're looking good, man.
Hey, it's good to be back. I didn't realize I was your first guest, so making my second appearance. I guess the first appearance went well, and I'm glad to talk to you anytime. I love talking charts in the market, so this is fun.
Excellent. Well, you and I have talked a little bit about my whole 56-week thing and how I'm setting up for Doomsday on May 14th. That's right around the corner. So, of course, I'm personally interested in looking for signs of that. And in your particular position now, you get a unique view of order flow, different from the way you had it when you're on the floor, right?
Yeah.
You give our viewers just a sense of what it's like as a market maker compared to what it's like as a sort of a broker institution, and what kinds of things do you see differently between the two?
Yeah, it's I was a market maker for 28 years, and as a market maker, my goal was to bring buyers and sellers together. And as technology evolved, we evolved, and the order flow would come through our pipes, and I would be watching buyers and sellers match electronically, as well as handling a crowd situation. But you would never get a sense as to where those customers were from regionally, or what kind of order flow they were dealing with, institutional versus retail. Now on the other side, not in the center of the action on the floor, in the center of the floor, I'm off to the sides, and you get to talk about what kind of order flow and who your customers are. And a lot of the things we're seeing is retail order flow. So what we do in the morning is we check what's trending in the retail world, going to the Reddit names, stocktwits.com, and their trending tickers is something I look at all the time. What's trending on Twitter. And we will find that those names, the meme stocks or the names in the news, are the stocks that we trade the most, where our activity is. So that is interesting, seeing a little more in-depth perspective as to what is driving the markets, where the order flow is coming from. And it's a different perspective that I like a lot.
I bet. That's really cool. When we a few years ago, when I used to visit you down on the stock exchange floor, I was always fascinated by the fact that your algorithms that were running constantly matching buyers and sellers. You also had the ability to sort of watch that, and then occasionally step in personally if you felt like, hey, this is a place I want to participate in the markets. I thought, man, that would just be so cool to have that kind of information and get a feel for it, and enough so that you felt like you wanted to buy post-COVID somewhere in the April timeframe. You bought some stuff, right?
Correct. I didn't know it was a generational opportunity at the time, but as a market maker, you're trained to be the other side of the trade. As a technician, you look for opportunities, levels of support when things are going down. I may have bought a little too early on that first sell-off, not thinking it was going to be the fastest correction since the Great Depression that we've ever experienced. But yes, I did get to buy some stock. I was actively trading certain stocks, but there were some stocks that I thought went on sale that I bought, and I've been holding on to.
So in our conversation, we were talking a little bit earlier, you mentioned that you have that point of view of, I'm going to buy this and I'm going to hold it and not think about trying to sell it until, right? So that kind of goes with my 56-week pattern thing, that there's people that feel like for some of their trades and for some of their point of view, they want to hold for a full year, tax consequences being top of mind in that area. So would you say that that's a prevalent market behavior?
Well, it's funny that you do mention the tax consequences because that has been a hot button issue over the last 4 to 6 weeks with the new administration. One of the things they talk about is raising the capital gains tax. In fact, there was a press conference about that middle of the day 3 weeks ago, I believe, and we saw the market
Right.
sell off. The Dow Jones Industrial Average sold off 300 points
Yeah.
in about 30
Yeah.
minutes.
Yeah.
So people were panicked. We did make it up. We did rebound, but it's funny you mention it because I was just looking at individual names that I bought, thinking, okay, what are the tax ramifications? If I sell it now, it's still short-term capital gains. If I wait 4 more weeks through 2 more weeks, it'll be that year, which happens to tie in with your thesis,
Right.
and I won't have to pay the long-term capital gains if it does go up. So if people are of that mindset, and considering I just looked at some of the winners I had, yeah, it could be a possibility. So it was interesting timing how it all ties into relevant news that we're watching as we speak.
Yeah. And you had mentioned that you don't feel like there's this impetus building for a huge cliff dive, but that maybe a 10% correction could come along here somewhere. What are you seeing technically that might lend the case for weakness?
Well, corrections aren't, crashes. They aren't, run for the doors. They do happen frequently over historical times. In fact, we're in a nice run. We haven't had a correction since COVID. We were down 9.8% in the Nasdaq back in September, which, if you round up, is 10%. So to me, was a correction. But there are two things. I look at the Dow, I look at the S&P. They just broke out to all-time new highs. So that isn't a sign of bearishness, but there could be a little excess froth. We haven't paused in a little while. The one area that has me a little nervous from a technical point of view is the NASDAQ. You see that double top forming. It hasn't broken out and confirmed what the other indexes have. And if you were to break down some of the top holdings in that, it gives you room for pause that, okay, maybe in certain areas we've come too far too fast. We've had a run up and we could pause, and that could lead to a 3 to 5% correction, maybe a 10% official correction. But in this market, in this long-term secular trend, I still think it's up, and I think it would be a buying opportunity.
Okay, so you noticed what I noticed, that
Mm-hmm.
earnings came for the FANG stocks. They all beat spectacularly, and still the news happened, right? It seemed like everybody institutionally hit the sell button right after earnings. Now, Google, it jumped, went down, and kind of worked its way back, and but they've all over the past week, the big stocks,
Yeah.
shown a fair amount of selling activity there. And so to me, I was thinking, oh, great, this is confirmation that 56-week pattern is going to play out. But you're right, everything else has been
Mm-hmm.
buying up. Do you have any sense or feel for what that's all about?
Well, I think it is important to focus on those FANG names, the Facebook, Alphabet, Amazon, Netflix, and Google. Maybe not so much Netflix. That chart has been kind of sideways and down for the better part of a year now. But you
Yeah, and they
mentioned
have
beating on
dropped in
earnings.
their market cap influence. So yeah.
Yeah, exactly. But you mentioned the theme of stocks beating earnings and failing to take that leg up. Facebook and Google did take the leg up. They did break out to new highs, and now they're flagging, as we say. They're retracing that gain. So there are key support levels to watch over the coming days in Facebook and Google. If they break back below those old highs, what they broke above on the earnings, I'd be concerned. I think the interesting two stocks in that group to watch are Apple and Amazon. Both beat, both traded up after hours, and then that day they gapped up, closed lower. That was a little, that gave me a little pause. We didn't make new highs. I think Amazon may have, but then it failed to hold it. Apple definitely didn't make a new high. That 140 level is key to watch. So I think, to your thesis, if there were, I don't like to nail it down to one or two specific stocks, but I think we can in this case, given the market weight, especially of an Apple being in the Dow, being the leading market cap of the S&P 500 and the Nasdaq 100. Watch it carefully. It hasn't continued that uptrend, and if it does take a little leg down, it could take a lot of stocks with it.
Yeah. So that's one of the things I notice is that Apple is a component in something like 350 ETFs,
Yeah.
and when you get institutions all making strategic decisions, if they just happen to make strategic decisions about Apple at the same time, I just wonder, isn't that going to have a domino effect and turn around and possibly, because, if Apple goes down, then it means the index goes down. And if the index
Yeah.
goes down, then it means the other stocks have to sort of rebalance and reshuffle. And, it's like, how big of a factor is that whole ETF interconnection world? I mean, what do you think about that?
Well, we all own Apple in one way or another. We all own Amazon because the diversification of portfolios and everyone having to be in the space where most people are. So Apple and Amazon. So there is a lot of truth to that. You will see people reshuffle, and if people need to take raise some cash, then they're going to take some of the winners off the table. And now to kind of go back to your theory, okay, it is 52 weeks to a lot of people that have the biggest gains. The biggest gains have been captured over the last year. So you wait, and now the tax ramifications could be a little less. Then it would pose that your theory and your timing could be spot on. I'm still waiting for more of a breakdown before I would go into, okay, 10% here we come correction. But I do think it gives credence. So you have to watch the highly weighted stocks because that domino effect could take place.
So I am never one. I should say never. I felt very committed to this particular idea, more so than some of the other times around. However, I know any good technician and technical trader needs to sort of say, well, I got my biases, I got my opinion, I'm going to work with that, but I can't pretend that I truly know the future. And the trade you're 100% sure of, that's the trade that's going to kill you. So
Yeah. Oh,
so I know all of that, and because I do, I'm looking at this pattern thesis that I have going, and I'm thinking to myself, well, if I'm wrong, what does that mean? It's always important to make sure you have a way of being able to profit when you're wrong. So I am watching to see, what if the sell-off, I think that, we've already seen evidence of sell-off started with earnings, right? The question is, how intense will it be? If it's not intense, then is that possible that that's the beginning of a very strong upside for pulling out of that? And when that historically has happened, that's 4 to 8 weeks, whatever selling kind of works its way through the market, and then when it's done, what you got left in buyers. So what would you see as the possibility for, say, mid-June to mid-July timeframe there, kind of the start of a much longer and fairly strong upward climb from there in the market? Do you see the possibility of that? Do you see evidence for that possibility?
yeah. I mean, you want to take a fundamental look. You want to focus on the Fed. The Fed is not rushing to raise rates anytime soon. They've been very transparent. And then we had an unemployment number that kind of surprised us. It was a negative surprise where not enough people are entering the workforce. But from an inflationary standpoint, okay, we don't have to rush to raise rates. We have another excuse to kind of keep rates low. So the backdrop of the Fed keeps me positive that we have some room to run. And then we're going into a seasonal time period where things can slow down. So the selling may go away theory. The volumes should be light. We could go sideways for a while, and if we do go sideways, which we have a little bit for the last few weeks, this isn't necessarily a bad thing. We had a nice run, and we're holding on to it. Where no one's panicking walking out the door, and you get through the next few months. Granted, volumes will probably be lighter because in this case, when you say sell in May and go away, we finally can go away. We have a chance to leave the house, and people will do that. I'm planning on doing it, and the table is set to actually take a leg higher, in my opinion. But it's never a straight line up, and to see a correction to me would be healthy. And as an investor, I always like to have a shopping list handy. Okay, I can't afford it at this level. I think it's overvalued. I think it's overpriced. But I have notes. I keep track of things. Okay, if it gets to this level, this is where I want to buy. And always manage risk. That's rule number one in everything we do. So if you make a call and you buy it and you're wrong, make sure you have that exit strategy. Okay, it didn't work. Let's get out. Let's minimize the loss and reassess the trade, look somewhere else. But if we go sideways to down a little bit, I think it's good. And if we don't have a big correction, we probably go sideways and slowly trade up. A slow rise isn't a bad thing. I think what we saw in the first quarter from, like, say, December to January, February, where you're seeing stocks go up 10, 20% a day, those pockets of strength they were anomalies. We're not going to see them again. But slow and steady wins the race. And for a long-term investor, I think we're in a good situation.
Excellent. Love that review. I want to mention here, if I can, the work you're doing with my friends at Drive Wealth, Rob and Steve and the guys. So you're enjoying that space with them?
I am, yeah. It's great to be on with a new team and a new set of eyes and getting that perspective. And they're excited to have their group on the floor, which I'm a big part of. And speaking of the floor, today on Monday when this airs, we're opening up to more people coming back to work. Not the public just yet, but COVID restrictions.
That's interesting.
Yeah. So I'm giving you an exclusive. They're going to talk about it all day on TV. Nice. But in fact, Bob Pisani should be there reporting from the floor for the first time since March 18th of 2020. Bob's a good
guy. That's cool.
Bob is a friend, and he is a good guy, and he's excited to be back. We're excited to have our full team back once we're fully vaccinated and gone through the protocols. We're going to be able to eat in our spots, take our masks down when we're not walking through the center of the floor. But when you see the New York Stock Exchange, you see traders walking in the background, we will have to have the masks up. We're not fully, okay, let's go back to the way it was, but it's another step in the right direction. So yeah, it's exciting to be with Drive Wealth and be part of that team. Exciting to be back on the floor and seeing that open up to more of a return to normalcy. I think after Labor Day, we're going to get more people on that podium with their masks off and more guests and visitors coming back. And Gordon, you're always welcome back once we reopen fully.
Nice. Thank you for the invite. I will take you up on that. I'm definitely going to be headed out that way in the summer, so we'll look you up.
All right. Excellent.
And thanks for your time today, Jay, and great insights on the rebounding and so forth. So we'll look to maybe have you back again in the future.
I'd be honored. It's always great to talk with you and your audience.
Hi, Gordon, you're on mute.
There, how about that? Am I back? Hopefully you can see my screen now. Yeah, good. Getting a couple of chats, so I must be back. All right, thank you. Thank you. Hope you enjoyed that conversation with Jay, and Jay's good buddy. So I'm having a great time listening and interviewing, re-listening to that interview I did with him. And I'm really looking forward to the possibility of getting back out there and to New York and visiting the floor with Jay again at some point here in the not too distant future. But meanwhile, I hope you picked up on a few of the things that he said. Number one, when he and I were talking before that interview, I just was reviewing what we've been talking about, the whole 56-week pattern, and he was surprised by that. He said, that's really interesting because I was just looking at when I'm going to sell my own holdings on Apple because he had bought Apple somewhere a year ago, and he was actually waiting for the that's in his personal account. Yeah. Um, yeah. Helen says, yeah, it was fun, but wonder if you have bad trades, then what do you do with all these sudden changes? Yeah, I mean, you don't put everything in one, and you cut your losses and move on, right? That's the perspective of the short-term trader. Because what if you are wrong? Well, if all you did was, I'm going to put all my money in Apple, I'm going to wait a year, and then I'm wrong. Yikes. Well, now I've just, lost a lot of time. Better instead, in my opinion, that you have multiple choices. I mean, that's the way the big guys play. They play 100 different stocks. They put 1% in each, and then one goes good, one goes bad, whatever. They get out of the bad and let the good run. I don't like that because that's, hey, just buy S&P 500, buy SPY, and be done with. All right, if you're going to do that. I like the idea that I'm buying 4 or 5 or 6 stocks, and I'm trading them. They're uncorrelated. When one's wrong, you cut it and find a replacement for it. So I hope that answers your question. But I want to give you some ideas of what do we do even if there isn't this big 56-week pattern sell-off. That's what I'm going to take you through today is some ideas that are probably going to be good with or without the sell-off. Now, before I get to them, I want to say, if the big sell-off is going to happen, May 14th is Friday, right? Will it happen on May 14th? It could happen before then, it could happen on then, or it could happen anywhere in the week after. So between now and the next 2 weeks, if we don't see a big significant, one day where the markets are down a couple of thousand, I mean, not a couple thousand, a couple percent, um, maybe yeah, maybe a 1,000 point day. Once it gets going, I think we'd see a 1,000 point day on the Dow. Um, but if in fact there's that kind of big sell-off, it could happen all at once because of some scary headline, right? The circumstances, people like Jay, high net worth individuals who've got big positions that they actually care about for tax purposes, right? And institutions. All of these people who say, I've got a bunch of stocks and I feel like I got to get out of them because something bad is about to happen, right? If there's some piece of news that makes people feel frightened about staying in stocks, then that connected with, we're all tempted to sell stocks now anyway. The two of those hit together, that's what creates the big sell off. And so I feel like all through the summer, that temptation is going to last because people bought in not just at the bottom, but all through. I mean, there were multiple 7% moves over a 3 or 4 month period of time. So that translates into all summer long. We're going to have people being tempted to sell. But the key, the most intense moment of that is May 14th. So it could still come. It could still be very dramatic. I am still focused downward with my big two trades on that I'm focused downward on are Apple and IWM, and that's the Russell 2000. And I think that both of those trades technically still look weak. I still think that there's significant selling to come for those. But what about if not, right? Well, as I got right here, Ethereum. Okay. I mean, Ethereum over the weekend, wow, we went from 35 and of course last week 3,000. Ethereum's up 25% in the last week or so. And that's pretty amazing, isn't it? It wouldn't be much if it wouldn't be super amazing if in fact Bitcoin were doing the same thing. It's not. Bitcoin is flat, Ethereum is running. Um, Ethereum is Cardano is another cryptocurrency that is kind of the same idea as Ethereum, and in theory must be something, or it could be something more efficient. Same idea, but more efficient than Ethereum, and yet it's not running, not like Ethereum is. So I have for a long time felt like, hey, Ethereum is the place I want to put my crypto money if I'm going to invest in crypto. The long-term possibilities for Ethereum I really like. It's really pie in the sky. It's super new, super early technology. But the reality is, if you don't know this, here's the bottom line that I keep looking for headlines to prove or disprove. Ethereum as a platform has the potential to decentralize the entire internet. You might think, well, internet's already decentralized, isn't it? Not really. I mean, the big companies own the biggest pieces, the most important. Google, Facebook, etc., Amazon. They all have their clutches on the most important parts of traffic flowing across the internet, and governments throughout the world have tremendous ability to censor the the flow of traffic within their countries and so all of that kind of stuff could be circumvented by a true decentralization of the internet, which the Ethereum platform could lead to. Could it happen tomorrow? Oh, no, 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 no. We're talking about a decade out. It would be at the minimum, right? It would take that much for society to put all the resources into building up the Ethereum blockchain and the Ether network and so forth. So the thing is, if people begin to believe in that idea, Ethereum is the new Bitcoin. I mean, literally, Ethereum is at 50,000 or higher in that world. And so I kind of think that this move from 3,000 to 4,000 is a few more people catching that vision, catching that idea and that potential. There's an event they call the flippening in crypto circles, or at least they got so dubbed way back when 3-4 years way back in crypto world 3-4 years ago. That's when they got started. But that phrase is getting trotted back out again. The flippening is coming. That is the point at which Ethereum has a higher market capitalization, more money thrown at it than Bitcoin does. I think that could very well come if people kind of get tired of Bitcoin, and at least in terms of growth prospects. Just over the past year, um, uh, just over the last year, I have had, or sorry, last couple of months, I've had the occasion to work with international people, and PayPal accounts are fine for transferring money, but there's a fee associated with that. Crypto, a lot less, right? So I have money in crypto accounts in case people I'm working with want to be paid in crypto, and I'm getting more and more people that are, yeah, I'd rather be paid in crypto. So I have a little Bitcoin, I have a little Ethereum, and tell me which one you want. Well, so far everybody wants Bitcoin. Anybody who says pay me in crypto, they just expect to be paid in Bitcoin. So I think it's kind of funny that we could see a world where, I mean, like within the next few months, where payments start to increase on the Bitcoin network, so much so that people just start thinking of it as a medium of um, electronic financial exchange. And that's huge because it may not make Bitcoin grow higher, but if it becomes stable, if it becomes a thing, I don't know how many people listening here remember, but back in 1990s, mid 1990s, when the internet was, you're moving from modems to actually having network connections and making it a little more stable, and people were learning what a browser was and what HTML was and all the things, who has a website? And shortly after that, all of a sudden, wow, there's this thing called eBay. And the idea that you could buy or sell online, use your credit card, oh, is it safe? Could it be, hacked? Could, that was a big worry for a lot of non-techno savvy people, but people who kind of ran a lot of commerce. Think, uh, think, you know, the stay-at-home moms, the office staff type people who, they're around computers, but they don't really understand the technology. Well, that crowd in the 1990s was uncertain about purchasing online. I think there was one thing that flipped the switch and made them say, I'm all in. I can buy on the internet now. And that was Beanie Babies. Oh yeah, I mean, I'm not even kidding. What happened was that Beanie Babies became a thing that you could, collectors could buy and sell on eBay, and all of a sudden, prices of Beanie Babies went crazy, right? Uh, uh, I remember somebody. I was working for IBM at the time, and there was this vendor who wanted to, get in good graces with me, and gave me a little Beanie Baby as a gift. I went home, gave it to my wife, and kids played with it, ripped off the tag, played. Yeah, yeah, they did that. it was this. It was this special edition Beanie Baby that was given out at the All-Star game at the uh, Major League Baseball All-Star game. Um, oh yeah, Shukri, we gotta talk about that. So anyway, so I get this Beanie Baby, and I find out a week later it's worth $500. I mean, we never did anything with it because we weren't there, but it was worth $500 on eBay to just take that in pristine condition and sell it. And so that just became a mania, and people started buying and selling Beanie Babies on eBay. And I really believe that was kind of the tipping point, that people got used to the idea of paying money, paying your credit card on the internet, and then shopping online. At least in the US, I think that really created an entry point for a large layer of people to consider getting online. And that from that point on, commerce on the internet was ever less and less of a thing to worry about. So we have not hit the Beanie Baby tipping point in crypto exchange right now, in using crypto as regular payments. It's a novelty. It's a, hey, I got to put money in because it could go up some more. That's where we are with crypto. And so the good news about that is, because it hasn't really found its footing functionally as a payments transfer system, there's probably still growth potential. There's still room to grow. There's still imagination to be had. Once we hit this thing, um, yeah, yeah. So Shukri, wow, like NFTs now, the NBA Top Shot moments. Yeah. So non-fungible tokens are that's still a novelty. Yeah, yeah. The big auction houses, and the people that have houses in Malibu or the Hamptons or some, or Gold Coast, Brisbane out there. It's like people that have more money than sense. They're spending it on that. So that's good. That's the beginning, but that's not the tipping point. The tipping point is when the majority of people are playing and interacting. I think the majority of people are playing by putting money into crypto and like, well, I'll just see. But they're not actually using it, right? Once people start using it, once you have this sense that we're on a trajectory for the majority of people to actually use blockchain technologies and cryptocurrency networks, then it's never going away, and it's a huge secular run higher, not run, but slow growth from there. And I think between now and then, there will be this big move, and then correction, and then that's kind of the way it always goes, right? Internet was all the way up to 2000, big 38% drop in stocks, and then internet stocks took off from there. So I feel like we're still looking for that dynamic to finish playing out in cryptocurrency. It hasn't been proven, which means it hasn't topped out. So Ethereum is a place that you can go. Um, if you're a stock investor, though, we don't, and you don't have cryptocurrencies, right? Futures, if you can play futures and crypto, you can get leverage and go there. We don't really have a lot of good places, stocks to buy that track Ethereum, for example. I wish there were an Ethereum ETF out there. I wish it were heavily traded, and wish it had options on it. And then I'd be hitting it. Meanwhile, I've just got money in there. All right. Um, the Beanie Babies. Helen says, I still have my Beanie Baby, still with the tie tag on it. There it is. You see, it happened. It was real. So Shukri mentions Ethereum to the moon, London fork in July. Shukri, seriously, I mean, I got to have you on here sometime in the next week or two. Let's get through Paul and set that up and have you come on and tell us all about because I know you're deep into the crypto world, but yeah. So Shukri making the comment, newbies seem to put money in Doge, not into functional stuff like Ethereum, Binance, Matic, Polkadot, etc. That's right. I mean, people who don't know anything about it, but they hear about it and then they look, well, Bitcoin's 58,000, but Doge is only $1. So I've heard other people say Doge. I mean, Doge is maybe there's a case, but I think Doge is like Litecoin. It's functionally it's not got any ability for its mechanism to constrain prices well enough. So it's all about people rushing in and people rushing back out, which will come. I fully expect there to be this massive crash on Doge. Not necessarily soon, but at some point. And yeah, good. Van Eck has applied for BTC and ETF or ETF. Yes, I'm watching for that. I'm watching. They're coming, so I'm watching for Van Eck or iShares or Power Shares. Anybody, whoever's first to market and gets those, because I think that'll be a heavily traded thing. I'm really surprised it hasn't happened already. All right. Meanwhile, let's go back now and look at this GDX. This chart here is gold miners and gold. So the bottom one I got here is gold, and that is just the price of gold. That's the one with the dots. And technically, we're breaking into the oversold thing on CCI. Now, the commodity channel index, that's this indicator right here. When it gets up above, they call it the old oversold region, but that's not. I mean, that doesn't mean, oh, we're going down from there. What that means is we're trending higher, and potentially we're going to stay up there as long as that trend goes. Look at when gold made its turn here over the past 6 weeks, 8 weeks or so. What was GDX, the gold miners index, doing? It was outperforming. And then these individual stocks, Franco-Nevada, Newmont Mining, and Royal Gold, all three of them looking good. The best one of them right there is Franco-Nevada. I have a different chart, however. It's like if you want to play gold, and I think gold is going to do well because it's the inflation trade. Now, not gold isn't always the hedge that people go running to if they're going to sell off and the bear market, and it's not even always a move if the dollar is going to drop. However, this time it has been happening. People are moving towards gold as the dollar is dropping, and I believe that the market there has been sufficient market manipulation over the past little while, past few years, I should say, past decade, by large banking institutions to hold the price of silver down and therefore hold the price of gold down. There was a big reason for wanting to do that. That reason doesn't seem to be there so much anymore. So I think gold is free to run a little bit. And so I feel like the gold trade, regardless of whether my 56-week theory plays out or not, is a really interesting trade right now. It hasn't been up until recently, but I think that there's a lot of room left to run in it. So I want to give you some ideas. Here's gold futures, for example, just since we've been talking as the 5-minute chart over the weekend, gold gapped up. This is after the bad news and the dollar drop and gold jumped. After gold jumped, this is what it continued to do over the weekend, still up. And just even as we're talking right now, you guys all must be out there buying gold futures or something because up it goes, right? No. Anyway, that's what gold's doing. So I think that there's still room to run. So here's this chart. I hope you'll find interesting. These are all three gold related trades. The bottom one, the blue one, is GLD, the ETF that tracks the price of gold. FNV is Franco-Nevada, the gold mining, of the top three high capitalized gold mining stocks, FNV is doing the best. So if you like gold miners, there. However, there's an ETF out there that actually is uh, double the price of gold, and that is NUGT. Now, in theory, if gold goes up 1%, NUGT is supposed to go up 2% on a day-to-day basis. But look at what's happened here over the past little while. From its lows, GLD is up not quite 10%, whereas NUGT is up almost triple that. Okay. Now there's this other one, GDXU, which is actually Direxion's 3x gold play. So it's if gold goes up 1%, GDXU goes up 3%. If you just can buy stocks, you're not into buying options or anything like that. These are your choices, NUGT and GDXU. Look to play them on swing trades. Whenever you see this sort of, they come down and then they make a turn up, great. Buy there. Your stop loss is just below. And then if it runs and makes a new high, you just trail the stop behind it, right? That's the kind of trade. It's really a good setup to be watching for here over the next several weeks. And if you're looking at NUGT or GDXU, either one, I mean, GDXU is way up there, 55% just in the past couple of months, right? There is a way to get even better leverage than all of these, and that is to buy options on GLD. So, as an example, you could go out there and buy July options that expire in July, and you could buy them at the 179, 180 strike price for about $2 per share. So, $200 would be what you could put into that trade, assuming you had an options account and could do that. You buy that GLD. So, if you had done that back here a couple of months ago, but just out of the money at 176 or wherever it is right now, if you'd have bought that, you could have picked it up for about $1.50, and it's trading right now around $4. So 150 to $4, that's not a 50% gain. That's 200 or 300%, right? So that's the kind of thing I think that is potentially possible for leverage plays on GLD. All right, so let's see, Helen. Were they don't doing that since December 2020? It just started moving. I mean, they weren't doing the manipulation. No. I'm talking about 2011, 2012 when they changed the margin requirements in the futures markets. About that same time, J.P. Morgan started shorting silver, in a very big way, and then over the past couple of years, JP Morgan has quietly been getting rid of their shorts, this huge short position in silver, historic large, right? It's like, where do they get the money and where do they get the confidence to do that? Ever since they've kind of unwound that silver short position, they've also been buying silver and probably buying gold too. And so as a result, I think what you have now is you have large banks that actually own the physical stuff, and they're not shorted. So they don't have the incentive to try to push those prices down through the futures market or wherever else. Now they have the incentive to try to drive it up. And so that's my thesis. That's where I'm saying the manipulation is coming in. I don't have proof of the idea that they've owned gold and they have the thing. I did have articles that I had copied that actually said that they had this huge short position. It wasn't me speculating that. I read that in a couple of different places, in a Forbes article and a few other places that that was the case. That J.P. Morgan had large short silver positions, and I don't know. That's a whole different sidetrack. I don't want to go down right now because we're out of time. But Gary points out it also drops hard as it goes up. Oh, you mean these leverage? I think you're talking about these leverage. Yeah, it's 3x. It goes up fast, but it comes down fast too. It's true. It's true. It's which is why you don't put your whole account in it. You pick out whatever you're going to buy, and then however much you would lose from your entry point to your stop loss, that better be about 2% of your account or less. So no, you can't just do the whole thing, um, because that's a gamble, and you're wrong about that, then you're out of the game. You can't keep playing, right? That's you sitting at the tables and the bouncer comes along and says, you're out the door. Your night's over, right? Don't play trading game that way. A couple other ideas though, real quick before we leave. Dow DuPont, the agricultural trade. If you're looking for stocks that have room to run still, and as things play out, regardless whether 56-week, DBA, that's an ETF stock that is all about agricultural prices. Look where it's gone. It's gone from 16 to 19 here just in the past month or so. If inflation hits and keeps going strong, DBA is going to be a beneficiary of that. Not a huge leveraged one, but it is there. Dow DuPont, as I mentioned, is a stock that is just barely showing signs of doing that. Another one is Caterpillar. Here's Caterpillar just breaking out of this long sideways move, getting ready to head higher. I mean, I'm not a big fan of playing plain old U.S. stocks because I'm thinking that the doomsday scenario, May 14th, is going to have a big impact on them. However, I think these stocks, Cat, Dow, DuPont, when they bottom out about 3 or 4 weeks later, they're probably great plays to be a buyer to. So those are some of the ideas. And then let's see. I think we're looking good for everything I wanted to cover. Let me see if I can run back to the charts here and see how the markets have opened up. S&P 500, we are out the door now. And what did we do? We opened up and we started coming down. Little fluctuation, not serious straight up conviction so far. Not picking a direction and going. It's Monday. We never see it jump straight out and head in one direction. However, as I mentioned before earlier, the Nasdaq is what was looking weak compared to the Aussie yen, and so I would fully expect that what we're going to see is a continued drop. Here is QQQ. Wow, look at that right out the gate. This is a 5-minute chart on QQQ, and so this was Friday, and you saw the Nasdaq 100 over the weekend. It was drifting lower, right? So that's where it opened, and then now straight out. So hey, that's evidence that the 56-week pattern has not. I mean, it's not impossible. If the Nasdaq keeps going lower and dropping and dropping and dropping, we're not going to get out of the woods without the S&P 500 or the Russell or any of these others being unscathed. The selling, I mean, right out of the gate, look at this. See, we're seeing this stuff sell off. I don't know how you could say this is anything less than see right there, the Nasdaq is now below where it closed on Thursday, right there. So that's pretty strong. So how far are we down? We're down not quite 1% yet with the Nasdaq. So if my 56-week thesis is correct, we're just getting started, just barely even getting started. And what I would expect to see, if in fact there is a real serious correction, more than 10% move that's about to happen, the day that it would that would catch everybody off guard. Wouldn't be headlines, wouldn't be good reasons why. All of a sudden, it would just be selling. Why would this happen? It would happen because high net worth individuals would all say, I'm going to take some profits here. And it wouldn't be that they all thought that they're all worried about it. They just want to take a little bit off the table, but that they all do it at the same time. And then all of a sudden the market drops and everybody's like, what happened? And then they get nervous and then they sell more, and the domino effect and the snowball gets rolling, et cetera, right? That's what happens if in fact this 56-week pattern plays out dramatically. And so what I would expect to see is a day where the market drops at the, I mean, there's a gap at the open like today. And then it just, I mean, but actually I would expect it to be a little bit bigger than a gap from yesterday. However, let me do this. Let me change this chart to daily and um, okay, so this is the 1 day, not the 5 minute. See, and you can see there that it doesn't look like a big gap there. All right, see this day back here, May 4th, right? Star Wars Day. There's a gap like that, broke through support and then kept going. See, that to me was the signal that 56-week pattern is a real thing and could really happen. May 14th really could be doomsday. Why? Because that kind of came out of nowhere. Since then, we came up and we hit resistance right there on Friday. And now what are we doing? We're dropping back down again. See, I expect if we're to see like this kind of thing, see, I think that May 14th, by my definition, should show this and more. I mean, the impact of that selling should drop us from 337 to 299. You know, that whole thing, it should be bigger than that. We should have more than a 30-point move, more like a 50-point move on QQQ, a $50 move. So 330 becomes 280, something, you know, that's the point at which I would expect it to be done and maybe come back out around. And if we were going to do that, see how there's that big drop right there, and then it starts trending lower. So we dropped, and then we're still weak. But I think the thing that gets it going is a day where we drop down, and then it keeps going, and then the next day gapped way down after that. So I think that there will be a couple of days like that that either begin this week or next week. And May 14th is, you know, somewhere on either side of it. There's anything special about that specific day that all of a sudden it's just going to happen that day. That's the marker. It's somewhere right around there. Okay. So watch out for it. It could happen anytime this week or next week. And if after this week and next week, it, you know, we haven't seen a big sell-off get started, then I got to reevaluate what that means in terms of you know, selling. The 56-week pattern doesn't have to happen. It could come a little later, but I'm not one of these. It's still coming. It's still coming. Still coming. No. It's my thesis is 14th plus or minus a few days, somewhere right around here. And if it doesn't, then I look at what the market conditions are. Are people just not afraid? If they're not, then that's worth knowing, isn't it? Okay. Let's see, we got one more chat comment here. How do you think the fall will affect currencies and which ones will be most affected? Okay, the most affected one will be the Aussie yen. If in fact it starts dropping, NASDAQ is going to drag the Aussie yen with it. This is why I constantly show the Aussie yen pair for your consideration. So we're looking at the NASDAQ or the Aussie yen still rushing up even as the NASDAQ is selling off. That's really surprising to me, to tell you the truth. But I don't think that can keep going. I think once the NASDAQ gets being sold in earnest, that turns around and comes with it. Barring that, if in fact that doesn't happen, then the next one would be the dollar, US dollar yen. So as you can see here, that one looks a lot weaker than the Aussie yen. The USD Euro USD rather, that pair, if stocks start dropping, you see normally Euro USD runs a little correlated with the US stock market. But in this world where we're talking about a lot of inflation and so forth, it really depends on how long and strong, how serious the sell-off is going to be. In other words, if in fact May 14th touches off something that will become a bear market, then yes, you would see the euro follow it down. And if in fact we don't see the euro follow it down, then we know that people are afraid of the dollar weakening so much so they're moving money into euros. That means that the U.S. Market, the stock market, will probably only correct a small amount and turn around and rebound strongly, right? So that's a thing to watch. But if in fact we have the correction that I'm expecting that will happen, currencies, I think you're looking at dollar yen, U.S. dollar yen. That's going to be a downward direction, and the Aussie yen turnaround also. Yeah, yeah, yeah. CAD. So CAD is uh, the Canadian dollar taken off, right? That's an inflation trade as well. I think that that's got more and more room to run. I think you're just, to the extent that the gold keeps going stronger, or oil, or both, CAD's going to do the same. So yeah. All right, that's about it. Um, yeah, dollar compared to CAD. Yeah, all-time low. It's got more to go. It's got more to go. So till next week. I'm way over time here. Appreciate everybody's comments and interaction. It's fun. So come on back next week, because next week's going to be really exciting. We will see if in fact doomsday has played out, and what that's going to mean. But if it doesn't play out, then you're going to want to know, how can I take advantage of the trades, the good trades that are going to be coming as a result of that. Until next time, everyone, take care and trade well.